And how do you fight inflation? Well, the way that happens is you get people to spend less by taking money and credit away from them.
The possibility of a recession is in the forefront of many Americans' minds. But how can we tell if we are currently in one? Technically speaking, a nation is said to be in a recession when the value of all the products and services produced during a particular time period, known as the gross domestic product, decreases for 2 consecutive quarters in a row. Are we heading towards an economic crash? Before getting into details, don't forget to subscribe to our channel and press the bell icon if you want to be updates. The exceptional expansion in the money supply since the epidemic will continue to keep inflation at historically high levels through the year 2024. It is usually beneficial to go back in history and look at the results of previous recessions in order to better control our expectations. During times of economic downturn, there is typically an increase in the number of people out of work and an increase in the number of people who are laid off. However, the length, severity, and repercussions of each recession are different. Additionally, getting access to the credit market can become more difficult, and banks might be more hesitant to lend money as a result of concerns regarding default rates. We will see an even bigger increase in the cost of borrowing money as the Federal Reserve continues to boost interest rates in an effort to clamp down on inflation. This will be the case for mortgages, auto loans, and business loans, among other types of loans. Therefore, even if you are approved for a loan or credit card, the interest rate will be greater than it was the year before. This makes it more difficult for households to borrow money or pay off their existing debts. This phenomenon is already seen in the home market, where the average interest rate on a fixed-rate mortgage with a term of 30 years recently approached about 6%, marking its highest point since 2009. During economic downturns, when interest rates rise and inflation falls, the prices of goods and services fall, and the rate at which we save personally could rise. However, this is all contingent on the state of the labor market and pay levels. Because those who have just lost their jobs are frequently looking for ways to make a company idea a reality, there is a possibility that we may also witness an increase in the number of people starting their own businesses, just as we did in 2009 during the Great Recession. Given that the unemployment rate is currently at 3.6%, the job market would appear to be, at least for the time being, the only component of the economy that is stable. However, it is expected that this will only be a transitory situation as some businesses are struggling to overcome the current financial. During the worst of the Great Recession, the unemployment rate reached a peak of 10%, and it took those who had lost their jobs an average of 8 to 9 months to find new work. If you believe that you do not have enough money in your emergency fund, now would be a good moment to take a look at it. If it looks like you won't be able to save enough money to cover a minimum of 6 to 9 months worth of costs, which is difficult for the majority of people, check if you can speed up your savings by reducing your spending or earning additional income. It is also an excellent opportunity to ensure that your CV is up to date and to initiate contact with key people in both your personal and professional networks. In the event that you are terminated from your job, it is imperative that you submit an application for unemployment benefits as soon as possible and obtain health insurance. If you are self-employed and concerned about the possibility of a downturn in your business or a loss of clients, you should investigate alternative sources of revenue. You should also make it a goal to build up the monetary reserves you have. To reiterate, if there is one thing that we have learned from prior economic downturns, it is that having cash enables you to make choices and gives you greater control over the situation during difficult times. Because of recent increases in mortgage rates and the fact that housing prices have not fallen nearly as quickly as economists had anticipated, purchasing a home may currently be more expensive than renting one. Since the spring of last year, fixed interest rates on 30-year mortgages have nearly quadrupled, which has contributed to a slowdown in the number of offers and a cooling of property prices. Nonetheless, competition among purchasers is still fierce due to historically low inventories. There are many markets where all-cash offers and bidding wars are still going strong. If you've been looking for a new place to call home for the past few months or the previous year without any success, you could feel worn out and defeated. Try not to be so critical of yourself. If you have not yet offered the highest possible price, you are not doing anything wrong. Even though it is true that a mortgage with a fixed rate might provide you with more predictability and budget stability, there may be some positive aspects to renting a home right now as long as inflation continues to outpace salary growth. This is especially the case in the United States. To begin, you won't be purchasing a property in a market that many analysts believe is on the verge of experiencing a bubble shortly. You run the danger of making a loss on the sale of the home if you are forced to sell it within the next year or two, which could coincide with a period of economic contraction. Second, renting will allow you to save the money that you would have used for a down payment and closing costs, which will assist you in being more liquid during this period of extreme unpredictability. This enables you to make quicker adjustments and protects your financial situation during a recession. Keep in mind that money equals power. Those who keep a close eye on the state of the stock market are aware that recent performance has not been very encouraging. Stock prices in the United States have been impacted negatively by growing interest rate expectations, which have been conveyed as a rippling effect from market crashes that occurred in Asian countries, particularly China. The question now is, how exactly does the stock market impact real estate? It's possible that the percentage declines are significant enough to catch the attention of high-profile investors, but the economy as a whole doesn't require as much concern just yet. For the past 6 months to a year, the real estate market in the United States has been characterized by a seller's market due to low inventory and a solid number of bidders. The national median price of a home reached $236,400, surpassing the previous high of $230,400, which was reached 9 years earlier. Recently, purchasers have started feeling confident enough to pull the trigger on house transactions. If consumers opt to keep more of their money in their pockets, then sellers will be forced to remove their homes from the market or begin accepting lower prices. Before you start looking at houses, you should first determine whether or not you have the financial means to purchase a property regardless of the state of the stock market. In the majority of states, the monthly payments for a mortgage are typically more than those for rent. And even when the rates are comparable, there are a variety of additional expenses that come into play when you buy a home as opposed to renting one. Before you purchase your first house, you should be certain that you will not only be able to easily handle the monthly mortgage payment, but also any other costs that may arise. The current price point is 43% over where it was before to the beginning of the coronavirus pandemic. The number of houses that are on the market increased by 27% from the beginning of September a year ago to the beginning of September this year. Even if the difference appears to be significant, it is not enough to make up for the fact that there has been a shortage of homes available for purchase for years. Although there was a slight spike in home buyer demand in August, the most recent rise in mortgage rates over the past week has put that demand back to sleep. The number of persons using Google to search for homes for sale decreased during the week that ended on September 3rd by 25% compared to the same week a year prior. After a hotter-than-expected inflation print shook financial markets around the world, Ray Dalio made a serious prediction for stocks and the economy.
Some of the things that surprised me with the most were things that never happened in my lifetime, but happened many times before. I learned that in 1971 when I was clerking on the floor of the New York Stock Exchange. And the United States, on August 15th, President Nixon got on the television and he told the rest of the world that the gold that the dollars are supposed to be converted into, you won't get. And there was a devaluation. I worked on the floor of the New York Stock Exchange and I thought it was going to go down a lot, and it went up a lot. And I found the same thing happen on March 1933 with Roosevelt doing the same thing. And that taught me history repeats, but not necessarily in our lifetimes.
His words were, "It looks like interest rates will have to go up a lot toward the higher end of the 4.5% to 6% range. This will slow the growth of private sector credit, which in turn will slow private sector spending, which will slow the economy." What do you think of our video? Let me know in the comments section below. If you enjoyed this video and want to hear from me again, be sure to hit that subscribe button before you go. Thanks for watching.